There will be profitable sales for a while, but in the long run, it will be full long, which is feasible for at least the whole of August. If you want to buy shares, buy them after adjustments come or buy them now. Here's the rationale. Following the announcement of the tariff agreement between the US and the European Union yesterday, July 27, 2025, here is a summary of the future prospects for the US stock market. Key summary. The US-EU deal is a 15% tariff on most European imports, much less than the 50% ultra-high tariff threat originally raised. The deal eased some of the US-China trade tensions and also played a role in lowering the risk of the Trump administration's tariff deadline. Stock market's short-term reaction. Dow, S&P 500, and NASDAQ 100 all rose 0.6%, led by futures markets. This is seen as a trend in which investors have regained confidence across the market, interpreting that uncertainty and tariff risks has eased. Global market context. Global markets have already rallied since the US China 90-day tariff reduction agreement, 145%, 30% in the US, 125%, 10% in China. And this EU agreement is an extension of that. Asian markets also gained strongly on news of US-China, US-EU negotiations, while futures markets continue to strengthen. Looking forward to the stock market in the future. A positive factor. Easing trade uncertainty is improving. Consumer industrial tech corporate earnings outlook. U.S. industrial groups such as defense, energy, and automobiles are likely to benefit from the expectations of alternative infrastructure and European cooperation. Plans to expand defense and energy exports under the EU agreement are also positive factors. Market watch. A recovery in investor sentiment in anticipation of a turnaround could lead to an influx of funds into the tech and consumer goods-focused stock group for the time being. Warning factors. The agreement itself is not a complete solution, and the unpredictability of a historic leverageable Trump tariff policy in particular remains a risk factor. Market valuations are already relatively overvalued, and UBS, BOE, and others recommend bubble risk warnings and hedging strategies.